Hello, my name is Christian Patel, and today we're going to be looking at Standard Bank Group's investments in Africa. We're going to be taking a look at their historical movements and doing a market analysis. So the criteria that we're going to be looking at is the triple bottom line, Standard Bank's business model, their entry mode into the market, their motivations for entry, and the market challenges that they face. So who is Standard Bank Group? Standard Bank Group is a multinational organization providing banking services throughout Africa. On the picture here, I have a picture of South Africa just by itself because a lot of the expansion that they conducted took place within this region before they started expanding throughout the continent. So in 1863, their first branch was established in Port Elizabeth on the southern coast, and in 1959, they moved their headquarters from Port Elizabeth to Johannesburg, which is the capital of South Africa. And their company mission is to be the leading financial services organization for emerging markets in Africa. Alright, so the first thing we're looking at is the triple bottom line, which is a measure of corporate social responsibility. It's based on the 3 P's: profit, people, and place. And these 3 P's are regarded as a good indicator for a company's ability to achieve long-term sustainability. So here we have a diagram of the triple bottom line. People refers to a company's communal impact. In the same way, planet is the environmental impact. And profit refers to a company acting in the interest of generating profit, as any company should. So, first aspect we're looking at for the triple bottom line is profit. In 1863, like I already mentioned, they opened their first branch in Port Elizabeth. So this is in regards to expansion, which is a very common profit motive for large multinational corporations as they have to expand into more regions. By expanding into more regions, you get access to more people, and in turn more sales, more profit. In 1962, they opened a subsidiary called the Standard Bank of South Africa. Opening a subsidiary is another means of expansion. In 1978, they acquired 25% of LibLife Controlling Corporation for a controlling interest in Liberty Holdings. So now we're getting into the acquisition and merger side of a profit motive, where by acquiring part of a company or merging with part of a company, you're able to access certain benefits or leverage certain advantages for a means of generating profit. In 1988, another acquisition, 49% of Union Bank of Swaziland, and in 1992, the acquisition of Grinley's Bank. And in 2002, we had the forming of a joint wealth management company between Standard Bank and Liberty Group, and this would be an example of a merger. Next aspect of the triple bottom line is community. In 1953, they appoint their first fully South African board. As I mentioned before, a lot of their expansion took place originally in South Africa, and so they have a lot of deep ties to that community. In 1967, they hire their first female branch manager at Johannesburg. So they also have their hand in women's equality. In 1986, Elizabeth Bradley becomes the first female on the main board. In 2004, the Tutuwa Community Trust was established, which was formed to invest long-term in the youth of Africa. In 2017, Sim Shabalala becomes the first black CEO of Standard Bank. And in 2020, more recent times, they did COVID-19 relief. They handed out 3-month payment holidays for qualifying small businesses and full-time students with loans. The last aspect of the triple bottom line we're looking at is environment, which they only got their hand in recent times. In 2019, they became the first South African company to table shareholder resolution meetings on a climate-related issue. And in 2020, they issued their first ever green bond in conjunction with the International Finance Corporation. A green bond is essentially a fixed income bond that's designed to contribute financially to specific climate-related and environmental issues. Later in the year, they also established the fossil fuels financing policy, which acts in a very similar way to that green bond. Next, we're looking at entry mode. An entry mode is a company's approach to entering a new market, a new foreign market, usually by bringing a product or service. And in the case of Standard Bank's entry mode into Africa, we're looking at 2 types, the greenfield investment and product innovation. Greenfield investment refers to expansion through wholly owned subsidiaries, branches, or any other type of institution. The key is that it just has to be in a foreign new market untouched by that company. So examples we looked at are the creation of the first branch in Port Elizabeth and their subsidiary, the Standard Bank of South Africa. We also have the London Representative Office, created in 1988, and their first international office in Taipei, Taiwan, established in 1989. The next entry mode we're looking at is product innovation, which is the creation of a new product or the improvement of an existing one. And for Standard Bank, we're looking at two products, their Access Account and Access Points, which were launched in 2007. The Access Account is a full-service product offering for low-income areas, and the Access Point is how it sounds, an access point for customers to conduct transactions with that Access Account. So before 2007, the product offering of Standard Bank was essentially individual product offerings, 3 to be exact, and the innovation aspect from Standard Bank in 2007 is the consolidation of these 3 products into a single product, which is known as the Access Account. So we're going to look at that breakdown here. Here we have the Access Accounts. I couldn't find a picture of an Access Account, so I just put Access Point. The first product offering before 2007, this is part of the consolidation into the Access Account, is the E-Plan, which is your basic savings account, the Monsi account, which is a low-cost version of an ordinary retail account, and the mobile bank account, which was set up through bank shops. Bank shops were essentially informal recruited retailers and community bankers. They were given cell phones that could access the accounts for mobile transactions, and so people throughout low-income areas would go to these people to conduct mobile bank transactions, essentially acting like their own access point in their time. But these 3 were consolidated into the Access Point. Their motivation for entering the African market, again with the Access Point and Access Account, is over here. So the Monsi account was the principal driver for this. They were seen as unprofitable, they did not represent the needs of the low-income people, and there's no opportunity for competition. So while intending to be low cost, the various fees associated with having a bank account discourage people in the low-income areas from transacting often within the month, and so this will result in a deposit or withdrawal of all their money at one time. This is known as sweeping in the industry, and it is very unprofitable for a bank. So in conjunction with that, not representing the needs of low-income people, there was also no opportunity for competition because the Monsi account was a common product offered by a lot of the mainstream banks. So with that all in mind, they consolidated these 3 into the Access Account. With that, there's going to be certain challenges for implementing their product, as well as market challenges, of course. So when talking about the Access Point and the Access Account, there's of course basic training to operate said accounts. There's bureaucratic hurdles like a proof of address. So a proof of address is a common document that's required to open a bank account. And this is a problem for people in low-income areas because their living conditions are very unstable, and so they're not often able to provide documentation for their living arrangement. And the Access Point actually hurdles this bureaucratic hurdle because the only thing you need to open an Access account is a valid form of identification. And so with that, people in low-income areas do not have to worry about the bureaucratic hurdles they have to pass in order to have an account in the first place. So it's more accessible. Another problem is getting customers to transact in the first place, which we touched on before with the Monsi account. And the solution to that by Standard Bank is providing commercial incentives. It's important to remember that an access point is a informally recruited retailer. So these retail stores would often have other products in that store, and so the solution to that would be pushing promotions for certain products at that access point. Lastly is ensuring e-float at access points, which are important because e-float essentially allow transactions to happen in the first place. So if there isn't a balance between cash and the electronic cash, you're essentially not able to transact any further. And so the solution to that is going fully electronic for one, which would not be good, obviously, for low-income areas. Another solution to that, which has already been practiced, is joint management between access points. Essentially, it's just a means of total quality control between multiple access points for one account. Next, we go into the challenges in the African market. A very obvious challenge for that Africa faces is widespread poverty, of course. In addition to that, increasing government regulations. for banks specifically. So they aim to reduce the risk that banks face when conducting major transactions, and they take the form of bank activity restrictions, like a lot of them, and capital requirement restrictions. There's a lot more, but those are a few for you. Now we're going to move on to the business model for Standard Bank. This is their target market, which is segmented into two, emerging and informal markets. The numbers on the left, the R8K, R3K, that represents the gross profit monthly income for a low-income earner. And so these ranges from 3K to 8K, for example, would represent the emerging market. So here we have the two, emerging market and informal market. Emerging market is a majority of low-wage earners, and the informal market pretty much consists of everyone else, so the inconsistent and the consistent earners, the social grant beneficiaries, and then survivalists. The key takeaway here, though, is that the target market targets essentially all of the low-income areas, but segments them based on income level. So from there, we can look at their actual business model for Africa, using their product, access points, and access accounts. They're distributed through recruited intermediaries, which would be those community bankers in low-income areas and local recruiters, and they're advertised as access points. And their target market, as we just went over, is people most likely to transact throughout low-income communities. So with all that said, that is my presentation on Standard Bank's movements throughout Africa, a market analysis on that. Thank you very much.